Welcome to Alpha Recap. Thanks for joining us. Today we're walking through the major sector stories from April 28th and what they meant after the close. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. The market closed on April 28th with a bunch of competing narratives. AI momentum, an oil move that caught attention, and a fresh wave of reshoring and industrial investment, all vying for leadership.
Yeah, it felt like a very two steps forward, one step sideways kind of day. Tech and AI pulled, energy pushed, and then policy headlines popped up and kept a lid on some of the moves.
Right, so what really stands out here is how headlines from different corners, corporate deals, commodity moves, and policy shifts all created a pretty balanced close.
Let's start with technology. The big call out was Amazon expanding access to models from OpenAI on its cloud. That was a clear signal that cloud providers are leaning into generative AI as a growth lever.
Exactly. Faster, more integrated access reduces friction for enterprise AI adoption. In plain English, companies can more easily put advanced AI into production on that cloud, which should lift related cloud revenue and also push demand for compute and storage.
And analysts noted this kind of integration tends to boost both software spending and the hardware that supports it. Chips, high-density storage, the whole stack. So tech was a clear outperformer on the day. On the other side, energy, there was a pretty dramatic headline. Brent crude topped $111 a barrel, and that pushed energy names higher.
That was notable. Pipeline disruptions and tighter flows around Hormuz were called out as drivers. When oil jumps like that, it helps producers and refiners near term, but it also raises input costs for other sectors.
Yeah, that tracks.
And because of that, the sector performance split was interesting. Technology, energy, and industrials were the day's outperformance group, while real estate, materials, and parts of finance lagged.
Before we get deeper, quick sidebar on industrials. Nucor reported a quarter that beat estimates, and there was also news of a $1.3 billion reshoring fund. Those two things together supported the industrial story.
Right, and that reshoring push is more than a headline. It's capital that should drive multi-year demand for steel, automation, and other equipment. So it's a structural tailwind for certain industrial names.
Short reaction, big move.
Not what anyone expected.
On the flip side, materials got hit by regulatory headlines. Subpoenas around plastics and packaging, and some disclosures around tailings, which created caution in that group.
Yeah, regulatory risk was a recurring theme. Cannabis rescheduling at the federal level, antitrust probes in materials, and increased crypto oversight all added a volatility overlay across sectors.
So let's pull that into some cross-sector themes. First, AI kept showing up as a unifying growth engine. Amazon's move to broaden model access on cloud was one clear example. And we also saw enterprise AI tools aimed at supply chains.
I mean, when you step back and look at this, AI rollouts are spilling into industrials, healthcare, and finance. Industrial software and automation providers got a sentiment lift, and healthcare pilots for AI in trials were constructive.
Second theme, energy price shock. That Brent print above $111 distorted a calm patch and made energy a short-term leader. But it also raised inflation and policy questions.
Exactly. Higher oil helps producer earnings, but creates input cost pressure for transportation and some industrials. And it can squeeze real estate margins in logistics through higher fuel bills.
Third theme was transition investment. The Department of Energy named initial developers for a nuclear energy launch pad, and a major utility signed a 200 megawatt, 800 megawatt hour battery deal. Plus, CATL pledged $4.4 billion to critical minerals.
Those are big policy and corporate commitments. They show capital moving into storage, nuclear, and supply for batteries, which links materials miners, equipment suppliers, and utilities in a project pipeline.
Right, and that matters because if projects move from pledges to contracted builds, revenue visibility for certain suppliers improves significantly.
So honestly, I was a bit surprised by this one.
Which one surprised you most?
Probably the combination of nuclear endorsement from the DOE alongside large battery procurement. You don't always see both accelerated in the same breath. That's a multi-technology push.
Let's hit the sector groupings quickly. Outperformers: technology for AI and cloud momentum, energy thanks to the oil rally and trading strength, and industrials because of reshoring and company beats.
Underperformers were real estate, which faced mixed transactions and financing friction, materials, which had regulatory pressure, and finance, where the tape was mixed and risk sensitivity showed up.
Stable or mixed: utilities had strong project activity but long duration constraints. Consumer and retail had omni-channel wins but some slower categories. Healthcare was mixed despite a good quarter from a major insurer, and crypto was a tale of institutional flows versus enforcement risk.
Short reaction? Yeah, absolutely.
A couple of notable corporate moves to call out: Amazon broadening OpenAI access on its cloud, Nucor beating estimates, the DOE nuclear launchpad developments, TVA's battery deal, CATL's $4.4 billion pledge, and Centene raising its guidance after a strong quarter.
And don't forget, Spotify posted about 8% revenue growth with modest subscriber gains, which is a reminder that media names are still grinding toward monetization, while rights and content costs remain a margin variable.
Let's circle back to the oil move because that has macro implications. When Brent jumped above $111 a barrel, analysts flagged higher headline inflation risk and a potential for central bank scrutiny if it persisted.
Yes, higher energy costs can feed through to consumption and wage discussions, so it was enough to keep some market participants cautious heading into the next data prints.
On crypto, the story was mixed. Institutional accumulation in Bitcoin and Ether, tokenization progress, and product innovation. But regulators tightened scrutiny. CFTC litigation and enforcement chatter created intermittent volatility.
That's a classic bifurcation: adoption versus legal risk. Flows and on-chain indicators show demand, but legal outcomes can flip sentiment quickly.
Actionable insights. And I want to stress these are informational, non-prescriptive. Start with AI and cloud monetization metrics. Watch cloud revenue guidance, adoption rates for AI products, and whether margins improve as AI workloads scale.
Also, watch oil trajectories and inventory data. With Brent above $111 a barrel, pipeline flow updates and statements from producers are important to track because that changes near-term earnings and costs.
Track government and utility project pipelines for storage and nuclear. Deals like the 200 megawatt, 800 megawatt hour battery system and the DOE nuclear efforts give you a sense of project timing and potential revenue ramps for suppliers.
And keep an eye on reshoring capital flows and automation funding. The $1.3 billion Reshoring Fund is a multi-year demand driver for equipment and regional supply chains.
Regulation as a risk. Incorporate event risk into models. Cannabis rescheduling, antitrust probes, and crypto enforcement can cause abrupt re-ratings. So scenario analysis is useful to avoid surprises.
For real estate watchers, it's worth parsing subsectors. Life sciences and some regional industrials have headwinds, while built-to-suit logistics and data center adjacency tied to cloud growth could be more resilient.
Use flows and on-chain data to read crypto sentiment, but balance that against litigation timelines. Institutional block buys or ETF flows can be leading indicators, but legal actions can wipe out momentum fast.
Okay, short checklist on near-term risks. Regulatory headlines, geopolitical events like Hormuz disruptions, inflation prints and central bank commentary, upcoming earnings from cloud and industrial names, and project execution risk for big energy transition builds.
And the million-dollar question, or rather the practical one, is execution. Can AI and cloud revenue convert into durable margins? Can large storage and nuclear projects move from pilots into bankable pipelines? Can reshoring investments avoid margin pressure from higher commodity costs?
Those are the right questions. Momentum suggests thematic winners will be those that can show scalable AI revenue or multi-year project contracts, while companies exposed to regulatory shocks or rising input costs may see more volatility.
We should pause for a moment on corporate governance and ESG execution risk, because CATL's $4.4 billion pledge and Barrick's North American IPO process reminded us that resource control matters. but permitting and environmental issues can slow things down.
Hold on, say that again?
I meant commitments to critical minerals are strategic, but execution hurdles like permitting and ESG compliance are real and can delay revenue realization.
Right, right. And the other thing is, those delays aren't just timing issues. They can change cost curves and project economics, which matters for anyone modeling long-term demand for batteries and electric vehicles.
Quick reaction segment.
Yeah, good point.
Before we wrap, a reminder on disclosures. This discussion is informational only. We are not recommending buying, selling, or holding any security, and this doesn't constitute personalized investment advice.
Analysts note that data suggests momentum favors scalable AI and secured project pipelines, but regulatory outcomes and energy prices remain key second-order risks.
Clear takeaways. 1. Technology kept leading on AI and cloud adoption. 2. The oil rally pushed energy into the spotlight and reintroduced short-term macro uncertainty. 3. Transition investments in storage, nuclear, and critical minerals are translating into multi-year project pipelines, but execution matters. And 4. Regulation is a volatility multiplier across several sectors.
Final thought. With the market closed on April 28th, headlines set the tone. The next phase will be about earnings execution and whether these thematic moves turn into durable cash flows.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back with more sector recaps. And remember, this was informational only, not investment advice. See you next time.
Take care.